Hi everyone, it's David Oliver here. Welcome to this week's taxessaved.com case study of the week. So this week's a continuation of great success we achieved for a client last week. A single filer out of the state of Texas was able to complete a $305,000 Roth conversion. And obviously last week you saw the benefit that provided for them for Medicare planning, things like IRMA surcharges we protected them from, as well as just the net tax savings they received for the strategy they employed. This week is now showing the long-term benefit of really the cost of waiting that they avoided by getting this conversion done sooner than later. So go ahead and recap what we talked about last week. For those that are new and listening in for the first time this week, definitely go check that last week's case study out. It's definitely insightful to what we're talking about today. But today we're continuing the long-term impact and what their ROI was potentially in long-term tax savings to them and legacy. So without further ado, I'll go ahead and share my screen as we always do, and we'll hop right in. So with that said, hopefully everyone's seeing my screen over here. And so you'll see, right, the last week we had client 64. Their income, about 305,000 of this 91,000 was Roth conversion. Right? And so they're facing a $102,000 tax burden, right? But what they do, they use a great Section 179 strategy or 168K in using a software investment. They invested 61K to get a $305,000 deduction. So they obviously use that to offset Roth conversion, and they brought their income after that $305,000 deduction from 391 in deductions as low to 70 grand with only a $4,200 tax burden. So the return on tax savings year one was a 160% with almost $98,000 of year one tax savings right off the gate, right? So that's strong. Today, we're going to show what a lot of clients don't consider that we take into effect and when it comes to tax planning for retirees, the cost of waiting and what these RMDs, these required minimum distributions, can do or really hurt clients if not properly planned around. So, with that said, this client, right, they had, if you see on my screen, a new analysis, and we can run this for anyone that meets with us. We run a custom analysis and planning and discovering with clients if this is a right fit for them. But with that, this client had about 1.3 million in tax deferred accounts before working with us and before converting anything as well. And they had that money growing on average from their statements about 8% per year. Now, they're in a 24% tax bracket. They're in the belief that taxes will go up, and many of our clients are. But here we just assume 24% now until the end, right? And death in this analysis kills everyone off at age 90, right? So here, right, over the next 26 years, this money's compounding till death at 8%. But their first RMD, because their birthday being after 1960, their first RMD is going to be age 75, right? So this RMD is going to come about 11 years from now. So as this money grows at 8%, here's the tax risk this client was facing without any Roth conversion. All right, so we're going to look at the left here. The right's wrong. You can't Roth convert 1.3 million at a 24% tax rate. You're looking at another 100 grand there. You can ignore that. The left's the big focus and why the conversion's impactful. So here, the first column or row you could say is total taxes paid on RMDs at time of withdrawals. So for them, age 75 to 90, so 15 years, just on the forced required minimum distributions, they'll pay $861,000. Okay. Now, the next thing to take impact here is what we commonly see is that the client doesn't need all the RMDs. Now, this could be skewed. A client might spend every penny of it, but commonly what we see is they don't. So they reinvest it. They go put it in money market, brokerage account, and gets hit with tax again. And so that's what that's showing, right? So another 412,000. And the last one, and this is a big one for this client, and is legacy planning, right? And the rules now, when you pass these accounts, your legacy has 10 years to spend these accounts down and it's all taxed on whatever their ordinary income tax rate. And here we're only assuming it's 24%. Now, over 26 years, anyone listening to this is probably going to guess, and I would agree with them, taxes were definitely going to be higher than where they are today, before we are as a country. But here we're trying to be conservative. So under these conservative variables of growth, they've achieved and what the tax rates are today, the total tax bill adds up to about $2.3 million, right? And you'll see this here is this compounding effect. Why Warren Buffett, Einstein tell clients all the time, consider it a wonder of the world. It's great in a tax-free environment like a Roth. That's what we want to get it to. But in a tax-deferred environment, it just creates a huge burden. So look at that. By age 75, about 123,000 right here of RMD, but they're only taking home 93 grand. Right there, they just gave up 30 grand to Uncle Sam, and it gets worse and worse every year, right? And so after the conversion, right, remember we converted about $305,000. That's exactly what we converted to recall for those that listened in last week. So we're going to show the same analysis. We go from 1.3 million now down to $995,000 left in these accounts after a $305,000 Roth conversion. Same growth, same tax rates, but instead of this big, ugly $2.3 million tax risk, we're now looking at something like 1.7. About $500,000 to $600,000 of long-term tax savings for them in their legacy now. Now that's a huge ROI. To save 98,000 on a $61,000 investment year one, but then to additionally protect themselves from $500,000 to $600,000 of taxes, that's the long game we're seeing here, folks. And it's really exciting to share that with clients as we break this down for everyone's own individual situation. Everyone's different. Some clients are in a higher tax rate. Some clients want to see a higher tax rate. Some clients have a high growth rate, right? And so this compounding effect, whatever it might be for you, you're at risk, right? And we're happy to go through that and share that with you. But here you can see it's all about getting a positive ROI and getting the solution solved here. And this was the big impact, right? We plan around IRMA, income related Medicare adjustments with that deduction year one in the conversion we did. So there was no penalties there. We offset tax liability with the deduction. That was a success there. And then thirdly, we greatly reduced the long-term RMD impact just in 1 year of successful tax planning. So hopefully you find this impactful. If you want to see more case studies, please again go check out taxessave.com. Every week at 6 p.m. Eastern, we release a new case of the week for our successful clients that really have taken our strategies to heart and seen the impacts for their own scenario. So if you'd like to see this for yourself, please reach us at taxessave.com. But if you'd like further information, please go look at case study of the week at taxessave.com. That's taxessave.com. Thank you and have a great rest of your week.